Jai Jagannath. Welcome all to my today's class on entrepreneurship and startup. Today we will discuss about O2C process. This process is one of the most critical financial cycles in any business, connecting customers' demand to revenue realization. Customers' demand to revenue realization. We'll look at each step of the process, its role in enterprise resource planning systems like SAP and Oracle, and also explore common challenges that businesses face. So, let's start. What is O2C? O2C process, also known as order to cash, refers to the complete cycle from when a customer places order until the company receives payment. Major ERP systems like SAP and Oracles have built-in modules to manage all this O2C process efficiently. It integrates multiple functions: finance, sales, and logistics. That is, sales with inventory, sales with inventory, inventory with shipping, shipping with billing, and billing with accounts. All these processes got integrated by this O2C process. This process is essential for maintaining liquidity and accurate revenue recognition and ultimate customer satisfaction. O2C process flow overview. How the O2C process flows in a system. The O2C process generally follows these 6 steps that I will explain here. The first step is inquiry. A customer expresses interest in a product, that is called inquiry. If somebody going to a shop to express his interest that whether this product is available, they want to know about the product, that is called inquiry. So first step in order to cash is inquiry. Next step is quotation. The company offers a formal price quote to the customer. The company offers a formal price quote. Next is sales order. The customer places a confirmed order. Next, fourth is post goods issue. Here the inventory is reduced and goods are shipped to the customer. Next process, that is fifth process, is delivery. Here goods are delivered at customer's destination. Then last process, that is sixth process in O2C, is billing. The invoice is raised and sent to the customer. So each of these steps plays a unique role in ensuring smooth customer fulfillment and accurate accounting. So let's discuss these steps in details to understand in a detailed manner about each of these steps and how a system behaves by these steps journey. The first step, that is inquiry. Inquiry is the very first customer interaction that I have already told. It is the expression of interest by the customer. So it is the first customer interaction step. At this point, the customer is only asking for information like prices, availability, or specifications. There are no financial entries under this step. However, ERP system records the inquiry with a system generated reference number for tracking and follow purposes. Here the customer inquires about a product through system. Here there is no accounting entry in the books of accounts, but once inquiry is made by a customers on the company's website, then the ERP system of the company automatically tracks the inquiry, and it starts interacting with the customers about why he has inquired, whether he requires this product or not, or वगैरह वगैरह. Next step is quotation. Once the inquiry is made, a quotation is generated. This is a formula offer to the customer mentioning the price, terms, and validity. A quotation may or may not reference the initial inquiry. It may refer the initial inquiry, may not refer the initial inquiry. But quotation is the second step only made after inquiry. Still, like inquiry, this step doesn't affect the general ledger. Here also there is no accounting entry. It's a commercial step, not yet any financial commitment. This is a commercial and purchase department's task to give quotation to the customers. Next step, step 3 is sales order. The sales order is the first formal agreement where the customer commits to purchase. It can be created directly or with reference to a quotation. Although it is a key document used for tracking deliveries and planning inventory, it still doesn't make any accounting entries. It is purely logistical at this point and is essential for controlling what gets shipped and when and to whom it will be shipped. Next step is post goods issue, or in short we can call it as PGI. PGI is a critical operational and financial milestone. Here the inventory is physically removed from the warehouse, packed and handed over to the shipping. This is the first point where actual accounting entry is triggered. What is the accounting entry? Here the cost of goods sold account is debited and the inventory account is credited. This reflects the goods have left the premises and are no longer part of company's assets. That means here actually the inventory is coming out of my godown. So transaction happens in my company where financial impact was there because inventory comes out of the godown and move to the customer. So accounting entry generated. So entry is the COGS account debited to inventory account. Next step is delivery. Here delivery refers to actual handover of goods to the customers at agreed shipping address. At this point the company records revenue and the customer becomes financially liable. So the entry will be revenue is credited and customers receivable is debited in the general ledger. This means the company has now legally earned the revenue and expects payment from the customers. Next is billing. Billing is the process of issuing invoice to the customers. Once the bill is sent, additional accounting entries are made. What are those entries? Customer account is now credited, showing that customer owes the company. The account receivable or cash account is debited depending on whether it is a cash sales or credit sales. So this closes the entire loop from the initial inquiry to the final cash collection. Here the transaction is completed in O2C process. So then we'll see what are the challenges faced under these processes. First challenge here is customer uses different channels like email, phones, web for placing orders. A customer may any of these modes. This is not it is not required that they have to follow only one mode of your web seeing the web page. They can give order on WhatsApp also. They can email also. They can call by to your representative for giving the orders. So this is one of the challenges in O2C process to handle all these modes of receiving the orders from the customers. Next is manual invoicing leads to delay and errors. Customers requires manual invoices as per their formats. So this also create delays because the invoice has to be made based on their requirements. Next, customer may pay via multiple formats. It may be paid by checks, maybe ACH, maybe credit cards, many of the modes. Next is disputes take time to resolve due to document verification and manual checks. Next is collection teams lack real time data. So high risk customers may be missed. High risk customers may be missed. Next is order placement. Next we will see these problems in details. The first of our problem is order placement diversity. So here what happens? Customer places orders in varied formats, emails, calls, websites, etc. This increases the risk of missing orders, duplicate entries, and incorrect fulfillments. Manual entries are time consuming and reduce process efficiency. A single error at this stage can disrupt the entire chain of the O2C process, causing shipment delays in futures, and also payment issues may arise in future because of these problems. Next problem what I have told is manual invoicing. Customer often demands invoices in custom formats like PDFs, web uploads, hard copy of papers, all this. This forces the team to generate manual invoices which are time consuming and error prone. Error in invoicing can lead to disputes, delayed payments, or even financial penalties also may come from the statutory authorities or from the clients also. Next problem is multiple payment formats. In today's business, companies receive payments in many of the formats, that is checks, electronic transfers, credit cards, all this. Each method has different processing times, charges, and risks. Foreign exchange fees and reconciliation becomes especially tricky in cross-border payments. The next problem is inefficient collections. Collection teams usually decide who to follow up with based on aged receivable reports. However, without real time visibility into payment status or customer risk, they may miss key accounts. This leads to higher overdue amounts and cash flow issues and missed early warning signs of default. So, next is problems on dispute resolution delays. Disputes can arise due to mismatches in pricing, quantity, and delivery. When dispute is raised, the deduction team manually reviews the emails, invoices, and documents. This makes resolution slow and frustrating for both businesses and customers. It also ties up working capital while the issue is resolved. It also ties up the working capital. Working capital is blocked because of this. So let's come to the conclusion. The O2C process is vital for generating revenue and maintaining liquidity. ERP systems enable integration and transparency across departments. However, without automation, organization may face delays, inefficiencies, and customer dissatisfaction. This is all about the O2C process.